Now, if you look at it properly, the next day, the stock opened all the way here, gap up. Can you see a gap up here? There was a gap up opening, but it could not sustain that gap up opening. So it went down, 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 and closed here. But thank God, even it went down, it closed above the closing point of the previous candle. This is its close. This is the previous candle's close. There is a gap here between the closing of this last candle and this candle, which means even though the stock is down, 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 and down and filled up, but there is some hint of bullishness within the overall bearishness, some hint of bullishness. And that's why, to give that hint to the user, instead of filling it up with red color, we have filled it up with green color. So basically, a green color candle in a hollow candlestick pattern, in this hollow candlestick pattern, a green color filled up candle does not mean that during the day the stock has gone up. No. In fact, during the day the stock has gone down, but its closing price is higher than the previous closing price, and that's why it's up. Do you really not think that this is too much confusing? Acha, gap down, how is that created? I'll show you. See, this is the closing point. Okay, look at the blue color now. Okay, this is the closing of the previous candle. Next day, where is the opening? Here. Can you see that next day's opening is here? This is, let's say, 60 rupees. Next day, the stock opened directly at 70 rupees. But after that, it could not sustain and it closed at 62. Now, even though there was a gap up opening from 60 to 70, 60 it was closed last day, 70 it opened the next day. So there was a gap up of 10 rupees. But during the day, the gap up of 8 rupees was lost. So the stock closed at 62. At least it closed at 62, which is higher than the close of previous candle, which was 60. Even though during the day the stock went down, at least it closed at 62, which was slightly higher than the close of previous candle, which was 60. So gap up hoke niche gira. That's represented using a green filled up candle. If any one of you are still not very much comfortable, right? Still, Mr. Sham, did you now understand the gap up? It closed 60, it opened 70 next day. Isn't it gap up? No. Yeah, great. Others are understanding. Mr. Sham, I'm just kind of reiterating it for you. Today at 3:30, when the stock closed, the market closed, the stock closed at 60 rupees. Next day morning at 9:15, the first trade which happened was directly at 70 rupees. This is called gap up opening. Gap up opening is always considered from the close of the previous day to the opening of the next day. If the next day the stock opened at around 60s, then it won't be considered as gap up or gap down. 58, 59, it's okay. Yeah, but next day the stock would have opened 55. Then we would say it's a gap down opening. Open and close price cannot be the same. Open and close price cannot be the same. That can only be same in a non-intraday chart. Let's say 5-minute candle. Then the open of this candle is going to be the close of this candle is going to be same as the open of the next candle. If this is the close, this is the open of the next. It's in a 5-minute, 1 hour, 2 hour. But on a daily chart, it cannot be possible, na? We discussed this in the last session also, if you have attended the last session, that a daily candle, in the daily candle, today's this closing is the closing of 3:30 p.m. There's no necessity that next day's open has to be same as previous day's close. That's not how the stock market works, my dear. Okay, so please understand that the opening price is not decided by the exchange. It's not the exchange which decides the opening price. The opening price is decided based on whatever happened overnight in the global world. Okay, please understand. I'd explained this in the last class also, that if a stock opened at 60 and overnight there was a bad news related to the stock, while the markets were closed, obviously, and people were sleeping, some bad thing happened with the stock. Next day morning, the stock will not open at the same price where it closed yesterday. It can open gap down. It can open gap up. It depends. If it was a good news, it can also open gap up. The opening price is the price at which the first share will be traded tomorrow at 9:15. it has got no reference to the closing price of the last day. Is it now clear? It's the, yes, it is the trade which happens at which price that decides the opening price. The exchange does not open the stock or closes the stock. It is we who trade. So let's say I was the last buyer or seller of the stock at 330 and my trading price was 60 rupees. So my trading price was the last traded price that will be recorded as the closing price. Next day morning, suppose someone else in the country bought the stock, wanted to buy the stock at 70 and someone else was ready to sell it at 70. So tomorrow's opening price will be first trade price, the first price of the first trade price, not the last trade price, the first trade price, that is 70. So people will see, oh, the stock directly opened at 70. Wow, so that's a gap up opening. Similarly, gap down is also possible. It's always the last trade which is closing price and the first trade which is the opening price. And there is no reference to the last trade or the closing price of the last day with the opening price of the next day. There's no link of that. There's no rule. Yeah, but there are circuit limits. So if a stock closed at 60 rupees last day and the exchange has decided that its circuit limit is 10%. So next day, the maximum highest point could be 66 and the lowest point could be 54, which means next day, even if it opens up, gap up, it cannot be trading above 66. It cannot be trading below 54. These are called circuit breakers or circuit limits, which has been imposed by the exchange in many stocks to avoid any drastic landslide loss to the shareholders. And in public interest, they have done this, that no stock can move more than 5, 10, 15, 20% in a day. There are different circuits in different stocks. So if there is a circuit limit of 10%, so the higher circuit will be at 66, lower circuit will be at 54, depending on the previous day's closing price. Now, what does it mean? It means the next day the stock can go anywhere between 66 to 54, but not below that and not above that. Those who want to madly buy it, they can buy it, but not above 66. Those who want to madly sell it, they can sell it, but they cannot offer their shares below 54. So at 54, if there are only sellers, we call it seller circuit. At 66, if there are only buyers, we call it the buyer circuit. The buyer circuit is called the up circuit. It means the stock is bullish. And the seller circuit is called the down circuit. It means that the stock is heavily bearish. I guess it's clear, right? Now let's talk about, since we have now understood the hollow candlesticks, right, in such a nice way, right? Every time what I'm doing is I'm trying to clear your overall doubts as well. It's not that we have only completed the different types of charts, but we have done a good discussion. Okay, so there's a small question which has been put up, that if the stock closes at 60 today and if it opens at 65 next day, high is 70, and if it again closes at 60 like previous day's close, will it still be green candle? Which means you're talking about the hollow candle, right? So I'll tell you, it is always about the closing versus closing. If today's candle's closing is above tomorrow's candle's closing, so closing to closing we will match. Where it went, where it opened, what was the high, what was the low is not our concern. We'll compare closing to closing. Okay, if this was the closing of the candle, let's say, I will just show you, if this was the closing of the candle here and the next day's closing is here, so we'll compare closing with closing. That's why it's green hollow. Now, if the same case would have happened here, then it would have become red hollow, because the closing is here and this closing is here. So it's overall, it's down. So we compare close to close, Mr. Samuels. Okay.